So how can I keep on changing my useful life of an asset depending on whether I am following or not following an accounting standard? Now that is going to be a challenge sometimes, especially for smaller companies. Sometimes smaller companies say that I will not provide for gratuity, let there be a qualification. Now they will not be able to fall under class 1, they will fall under class 3. So in one intermittent year, if they don't follow some accounting standard, in the other years they follow, how do I calculate depreciation? How do I go up and down in class 1 and class 3? That is going to be a challenge for a lot of companies. For intangible assets, you follow the provisions of the standard, which means you amortize over a period of 10 years. Now what is also brought in by schedule 2 is component wise determination of useful life. This is also IFRS which is coming in. Now what that means is, if the cost of any part of an asset is significant to the total cost of the asset and the useful life of that part is different from the useful life of the remaining asset, useful life of that significant part is to be determined separately. And the classic example which is given under IFRS in this is of an aircraft. Aircraft, as that example says, has three distinct components. One is the aircraft body, one is the aircraft engine, and the third is the aircraft upholstery, the seats which are there inside. The aircraft body may have a life of 20 years, the engine will have a life of maybe only 5 years, whereas the aircraft upholstery will have a life of only 2 years, because that is subject to very high wear and tear. So what IAS 16 says is that the body of the aircraft you depreciate over 20 years, the engine you depreciate over 5 years, and the upholstery you depreciate over 2 years. So when I buy an aircraft, I buy a single thing, but I have to break up that cost into different components. Now, this is to be done for all items of fixed assets which a company has now. If it is plant and machinery, you will have different components, you break it up into components, find out the useful life of each component and accordingly decide depreciation. How feasible it will be for a company? A small company is difficult. Even for a big company, it will require a very robust fixed asset register, because unless you have a fixed asset register with its different components identified, you will not be able to do this. But this is a mandatory thing from April 2014, assuming the law comes in April 14 as such. And for a listed company, in the first quarter, this will affect you. So in June 14, you have to be clear that you will follow this componentization when this starts applying from April itself. Now this is clearly IFRS coming in straight away for all companies. Now whether IFRS is adopted or not, some of these provisions are automatically there for all your companies. This is again a big opportunity for professionals to help companies to prepare a proper fixed asset register, decide what are the components and arrive at a proper depreciation policy. Most big companies would like to take external help, because otherwise they will not be able to follow a proper policy for these components and depreciation policy which is there as such.
This will apply to existing assets also?
This will apply on all assets.
New asset or existing asset?
All assets.
All assets. Old assets.
Yes. And that is because there is a transitional provision which says carrying amount of the asset on that day is to be depreciated over the remaining useful life. So all your assets which are there as on the date you apply this new act, you find out what is the remaining useful life. If the remaining useful life as per your components or as per that schedule 2 is nil, whatever is the value left, you assign it to, or mean just take it to your reserves. Otherwise you depreciate over the remaining useful life. So if you are depreciating say an asset over 20 years, as per schedule 2, the life of the asset comes to only 12 years. The asset is say already 15 years old. Then you have got some figure which is lying in the asset which should have been actually written off because of the schedule 2 requirements. If it is already over, that life is already over, write off that amount to reserves, take it to retained earnings. But if it is not yet over, few years are still left, you amortize that remaining value over the balance period, which means your depreciation charge for that balance period would be much higher than before as such. Lot of companies we believe are still not appreciating this big change which is there, and we believe that in the next year the depreciation of companies will increase by 20 to 50% only because of this. because your useful life is going to come down and your depreciations are going to increase straight away without doing anything. So this is an exercise which everyone needs to carry out, whether a big company, small company, they need to carry out this exercise itself, and I do not know how many have really started doing this as such.
Sir, one question is like a company is importing a machinery, company is importing a machinery which is like a 30-year-old machine which is required for their business purpose. If you come to this company that now useful life is 15 years, so what will be the scenario?
Whatever is the balance left in your books,
30 years machinery means there is no balance. Useful life is
then you are not worse off, then you are anyway not doing anything.
So first year there will be charged to the kid.
No, the machine is already there or you are now bringing in?
Going to bring.
So if you bring in a machine which you say is 30 years and the schedule 2 says it is 15 years, you will have to amortize over 15 years unless you fall in that
No,
class
my
1.
question is, these are second-hand machineries.
Okay.
And it's already outlived its useful life. But still I feel it is very important for my business and I am importing it. And let's say 20 years are already over now. Still I am using it. So when I import it, do I have to charge it to my profit? In the
No,
first
when you
year?
now import the machine which is already say 20 years old, the life starts when you buy the machine. So when you buy the machine, there is a life already provided further for that machine. So you follow that further life.
Same concept will apply to second-hand machinery bought within India.
Everywhere, because schedule 2 just gives you estimated useful life. It doesn't say new or old or anything.
So does it mean that if I have a second-hand machinery, I should sell it and then rebuy it?
He was the previous.
I am only here to explain the act.
He was the previous and 100 extra shift depreciation. If you can just explain this. Extra shift.
Yeah, so extra shift depreciation is still there. If your useful life is there and you compute depreciation, and if your that asset is being used double shift or triple shift, you again increase the depreciation that much. Straight away, which is again not correct, because if you are going by useful life, you don't need extra shift depreciation, but it is still there.
So if it triple shift straight away 100%.
Yes. But there is no provision now to write off assets below 5,000. But there are some strange items in that list of schedule 2. For instance, it says mobile phone estimated useful life is 2 years. So mobile phone today, if you are writing off fully, because such is it's a consumable nowadays. But now you will have to depreciate over 2 years because it is there in schedule 2 now. There is an estimated life of 2 years.
For the component wise breakup, you would have paid just one amount for the whole machine. Now there would have to be some basis for the valuation.
You can appoint a valuer to do it, or the businessmen normally know how this breakup is there, because when they issue a purchase order, they know how they have issued a purchase, or there is always a valuer available to do this for you.
What should I this word? Significant will have to be given. some-
Yes, that significant means clearly means there is a threshold which you need to take, that if my asset is, say, my total asset base is 100 crores, I may decide that for deciding my components I will have a threshold of 5 lakh rupees. Below 5 lakhs I will not identify components. So that is that word significant which is there.
But is it total? Is it total income or is it that particular asset? I believe it is that particular asset.
Agreed, but that is still giving you some threshold. And to just give an example, I believe L&T when it went to execute or implement IFRS, the same concept, they have taken a cutoff of 10 lakhs. So any asset below 10 lakhs, they said is not to be further broken down into components.
So it is with respect to value, not with the criticality of that.
No, it is with, I mean that is a company decision to take. The company will decide that. The company will have to decide that depending on how much details are available to it. But obviously it cannot be which is a very material amount. It has to be small amounts. Another issue which comes up is what happens in the case of a revaluation. In case of revaluation today, we draw something from a revaluation reserve. The new schedule 2 in the new depreciation section will not really allow you to draw anything from revaluation reserve. So the depreciation will have to be fully charged based on the life of the asset without drawing anything from revaluation reserve. Again, this is what it seems so now. unless the institute or the MCA comes out with some circular or a guidance note or some notification on this. But as it stands, it seems that the revaluation reserve, you will not be able to draw from it for a depreciation on a revalued asset. This itself will increase your depreciation.
Year revaluation reserve what?
Let it remain in reserve.
It will remain.
It will continue in reserves
Continue as it is.
as it is. Donations. This is again something which is, as auditors, we now need to really comment clearly on this. Donations can be for bona fide charitable and other funds. If the contribution exceeds 5% of average net profits of the preceding 3 financial years prior permission necessary. However, for political donations, instead of 5%, you can have 7.5%, and the resolution stating such contribution should be passed by the board. So this is what is clearly there, but there is a provision that whatever donations you make to whichever charitable trust, you need to disclose the names. This is a provision which was there in this. Now obviously a lot of companies in the last 3 months have been telling the government that if you ask us to give all the names of whomever we have donated, especially political parties, then if I have given more donations to say this UPA government and less to NDA, and the NDA government come, we will be in a problem, or vice versa. So they said we will not give us some exemption whereby we may not be able to disclose names of political contributions which are there. And the government came out with this circular in December, which said that if you are giving a donation only to an electoral trust company, then you don't need to disclose, but the electoral trust company will then further disclose the names of the political parties. So if you make a contribution to an electoral trust, you don't need to give what is the trust further doing, because that's a lump sum contribution or a donation which you are doing. Further what they are doing is none of your concern as such. We'll see what are the implications of this circular which was there, but in case you are not satisfying this condition, there is a penalty of 5 times the contribution and even imprisonment up to 6 months. So what can happen very well is, if I have given a donation to a particular party in excess of this, the party will take the donation also and also imprison me. Because they will come in government and they may even imprison me because I may not have fulfilled some of these sections. But there are a lot of electoral trusts which have been formed of late. You initially had only one Tata electoral trust, but several big groups have now formed electoral trusts. A lot of these groups have formed in the last few months, and there were about 30 more applications pending, which I am sure by now those trusts would have been formed. And these trusts would get money from the parent companies, and they will in turn give it to the various parties. Which parties they are giving is not in public domain now, because that is an electoral trust. And to help the electoral trust, there is a exemption available under Income Tax Act that if you contribute 95% of that income, then there is no tax on the electoral trust. So what if they receive 100, they would have spent 95 by giving political donations.
Sir, if the charitable trust is carrying on Schedule 7 activities, and will it qualify to CSR?
It can, provided you fulfill those conditions of Schedule 7. Because as we said in CSR, it could be your own activities or it could be outsourced to someone. You can yourself do it or outsource it to someone. When it comes to dividend, the main change which is there is you don't need to transfer anything to reserves. Dividend can be paid out of profits or accumulated profits. Depreciation has to be provided in both cases. Transfer to reserves, however, is at the option of the company. Earlier you had compulsory transfer to reserve rules. Now transfer to reserve is at the option of the company. You can declare interim dividend out of current year's profits, but if you declare interim dividend, if there is a loss in the current year or earlier year, there are some rules for the rate up to which or beyond which you cannot declare that interim dividend. You cannot declare dividend if the company fails to comply provisions relating to acceptance and repayment of deposits. So if I not complied with even maybe giving an advertisement properly, then you may not be able to pay dividends. What is surprising, however, is is transferred to IEPF for unpaid dividend. The provision today is that if I have got unpaid dividend for 7 years, I transfer that amount to Investor Education and Protection Fund, IEPF as we normally call it. The new section now says that if you have got unpaid dividend for 7 years, along with the dividend also transfer the shares to the IEPF. So the draft rules say that this provision applies only if the shares are not held in demat form. So if the shares are held in physical form and the dividend on those shares is unpaid for 7 years, the dividend anyway goes to the government, the shares also will go to the government. Now how this will impact people is, you have a lot of non-residents who are not in India for several years, they may not have even dematted their shares. So if say a non-resident who is working in a high position in USA has 1000 shares of Reliance and the dividend on those shares is unpaid for 7 years, he may find that after 10 years when he comes, the dividend has gone, the shares have also gone. That is what will happen. So at least we have to tell all people that at least convert your shares to demat. And what we are now advising people is even private limited companies, please convert your shares to demat form. So that is also a possibility. There is no rule which does not bar a private limited company to issue shares in demat form. In any case, private limited companies never print share certificates. So it's always easier to straight away convert them to demat form. At least such provisions will not kick in when you have disputes among promoters or something. Otherwise, those disputed shares may also go to the government as such. From the government, there is a procedure laid down how to claim the dividend, how to claim the shares, but that, as you know, is a very difficult thing sometimes to get something back from the government. Loan to directors, I know this is a topic which is also going to be covered by Nilesh, but I have just included 1 or 2 slides because this is going to affect auditors straight away this year itself. It corresponds to section 295. The section is already operational from 12th September and it applies to any loan given directly or indirectly to any director or any person in whom director is interested or gives a guarantee in connection with any loan. Now the problem comes with this phrase, any person in whom director is interested, because it includes any body corporate in which not less than 25% of the total voting power may be exercised or controlled, or the board is accustomed to act in accordance with the directions or instructions of the board or any of the directors of the lending company. Now what that means is I literally cannot give a loan to anyone in which I am interested, because any person in whom director is interested can cover a lot of things, including my subsidiaries or anything. So what therefore happens is, as far as from the old section 295, the exemption to private limited company automatically is removed because that exception is not there. Exemption from loan from a holding to subsidiary is removed, and it does not contain any remedial proviso. It does not say that except with the approval of central government or by a special resolution or something. Earlier what was there, if you make a mistake in a section, you can say, okay, I will go to central government, say that I have made this mistake, and you say that, okay, now please ratify my mistake or give now conditional post facto approval. Nothing is there in the section.
Can this be constitutionally valid? But I am
No one has objected so far.
I am debarred from giving loan to all these.
But there is no one who has objected so far. And this, some PSUs made a representation to the MCA that this is a very difficult section to comply. The MCA said this has been deliberately done. We want to discourage people from doing this. That is what their informal answer to the PSUs have been. So this is a deliberate decision which the law ministry has accepted. So whether constitutionally valid or not, at least no one has challenged it so far, because this is a section which is operating today. And so if you do something, you straight have that penalty and imprisonment, because that is the straight implication if you have given a loan, even by a private company or from a holding to a subsidiary.
So whatever to old loan balances.
Old loans will continue till you renew them. If you renew them, you will have a problem.
There is no cause of renewal, it is perpetual.
But that is not possible. No? That is not. It will then get renewed in the first day of the next year if you don't have any clause. So you at least put a 5-year period. At least for 5 years you don't have to bother. After that you will have to start bothering. So put some upper limit to the loan. Otherwise it doesn't remain a loan, frankly. Now there was a circular which came in February 14, which was again at the behest of the bankers, because this even prohibits guarantees. You cannot even give a guarantee to a banker for a loan taken by a subsidiary from a bank. So the finance ministry actually forced the MCA, Ministry of Corporate Affairs, to come out with this circular, because banks were saying that if you don't remove this, we are not getting any security from the lenders. So therefore finance ministry put pressure on MCA, and therefore this circular saying that guarantees given would be exempt if the loans are exclusively used by the subsidiary for its principal business activity. So this is a very small exemption which has been extended. What is required is exempt private limited companies from this, and also exempt loan from holding company to subsidiary. Lot of people are asking us, what is the institute doing on this? And the answer I give them is, how am I concerned as an auditor in this? It is your problem. This is not the auditor's problem. This is not the institute's problem. You go through the industry representations. As an auditor, I am only supposed to report on this.
How a company can do business without finance?
So that is not the auditor's problem.
His provisions are blocking the.
I agree, but then why the institute should represent on this? I am very clear on that. I tell everyone who comes to me that please go to IMC, please go to SOK, please go to CII. But the institute or BCA is not going to write anything on this, because even the minister may say, why are you coming to me?
And most of the time
Yeah.
they do say so.
Looking for extension of IT return. Why are you?
Okay. If you are able to go through all this, then obviously you have to do the audit later on. If accounts are prepared and consolidations are done, then this provisions relating to auditors. Currently you have appointment which is done every year. Now appointment will be done every 5 years. Ratification to be done every year. Mandatory retirement after 5 years for individuals and 10 years for firms. Provisions applicable to all listed companies and other prescribed companies. And no auditor or firm having common partners will accept audit for a further 5 years after 5 years are completed. So that's the cooling period of 5 years as we understand. Transition period, you comply this within 3 years. The company and members can also decide that audit partner will be rotated at regular intervals. Central government approval and special resolution required to remove auditor before term. Also company needs a special resolution at the AGM. And the draft rules say that this will apply retrospectively, which was also there in the Act. So this applies retrospectively, but the draft rules